Welcome back. It's Wednesday, August 6th, 2026, and this is your daily AI value briefing. Every day, our AI screens the market for high-quality companies trading at unusually cheap valuations, and we accumulate those picks through steady dollar-cost averaging, adding new names as they appear. U.S. markets have been grinding near record highs, with software and AI-related earnings mostly beating expectations, even as investors debate how soon the Fed can cut rates again. Against that backdrop, beaten-down quality software remains where the screener sees the most value. Today, the AI surfaced 5 picks: Adobe, Autodesk, Salesforce, Workday, and VEEV Systems.
Quick portfolio check-in. Everything is measured as if bought on the recommendation day, with alpha versus the S&P 500. PayPal leads the book, up 28.5% for 26 points of alpha, followed by Workday, up 23.7% with 21.2 points of alpha, and Adobe up 18.9%, beating the index by 16.5 points. Autodesk has gained 15.7%, VEEV 11.2%, and FactSet 10.1%, all comfortably ahead of the market. The newer ads are working too. Salesforce is up 6.3%, and ServiceNow 6% since late July, each with about 2 points of alpha, while Intuit joins the portfolio today at cost. On the losing side, Insulet is down 16.6%, trailing the index by 19.1 points, and Netflix is off 2.4%. Reminders that not every pick works, which is exactly why we diversify and keep averaging in.
First up is Adobe, the creative software giant behind Photoshop, Premiere, and a fast-growing digital marketing platform. The stock sits roughly 29% below its high, in the 97th percentile of its own historical cheapness, and our reverse DCF says the market is pricing in essentially zero growth. For a business with an 89% gross margin, a 70% return on invested capital, and earnings that grew 57% last year. On the direction side, estimates have been revising higher, and recent quarters have consistently beaten expectations, so the fundamentals point up while the price points down. That's the classic mispricing our screener hunts for, and it scores 93.7, the top mark today. The key risk is the AI narrative. Investors fear generative tools could erode Adobe's creative moat, and until that debate settles, the multiple may stay compressed.
Next is Autodesk, whose design software like AutoCAD and Revit is the backbone of architecture, engineering, and construction worldwide. Shares are down about 27% from their peak and sit at the 98th percentile of historical cheapness, the most extreme valuation reading on today's list, while the market implies just 5% long-term growth for a company compounding revenue at 13%. Quality is elite, a 92% gross margin, a 51% return on invested capital, and earnings that more than doubled over the past year as the subscription model matures. Earnings beats and accelerating quarterly momentum back up the value case, giving it a score of 89.9. The main risk is its exposure to construction and manufacturing cycles. A hard landing in those end markets would slow new subscriptions.
Third is Salesforce, the world's largest customer relationship management platform, now pushing hard into AI agents for the enterprise. The stock has pulled back 27% from its high, trades in the 92nd percentile of historical cheapness, and the reverse DCF implies the market expects revenue to actually shrink about 2.5% a year, a strikingly pessimistic assumption for a business still growing near 10%. It generates a hefty 10.5% free cash flow yield. Earnings jumped 80% as margin discipline took hold, and recent quarters have beaten estimates, with upward revisions following. The soft spot is its 13% return on invested capital, dragged down by years of large acquisitions, and the risk is that slowing seat growth in core CRM offsets the new AI revenue before it scales. It scores 80.4 today.
Fourth is Workday, the cloud platform large enterprises use for human resources and financial management. It carries the deepest drawdown on today's list at 31% below its high, sits in the 87th percentile of cheapness, and the market is pricing only about 2% growth against actual revenue growth of 15%, the widest growth gap of the 5. Reported earnings nearly quadrupled as the company pivoted from growth at all costs to profitability. And beats plus rising estimates confirm the momentum is real. The 75% gross margin is strong, though the 11% return on invested capital shows the margin story is still young. The risk: HR software is tied to corporate headcount, so a weakening labor market would directly slow bookings. It scores 79.8.
Rounding out the list is VEEV Systems, today's only non-technology sector pick, the dominant cloud software provider for pharmaceutical and life sciences companies. The stock is down 30% from its peak and in the 90th percentile of historical cheapness, with earnings up 78% and revenue compounding at 14% on a 75% gross margin. One honest caveat: the reverse DCF implies about 12% growth is already priced in, so unlike the others, this one needs continued execution rather than mere survival. But estimate revisions and steady earnings beats suggest it's delivering. Its grip on pharma customers is nearly monopolistic, which supports a 15.6% return on invested capital with almost no churn. The risk is its self-imposed migration off Salesforce's platform onto its own infrastructure. Any stumble there could disrupt customers. It scores 77.7.
That wraps up today's briefing. 5 quality software names the market has left on sale, and a portfolio that keeps compounding one daily buy at a time. Same time tomorrow, the AI will be back with fresh picks. If this format helps you, consider subscribing so you don't miss a day. This video is auto-generated for personal record-keeping and is not financial advice. All investment decisions are your own responsibility.